Welcome to the London Business School webinar series, Leading Through a Pandemic. I'm Julian Birkinshaw. I'm a professor of strategy at London Business School, and I'm your host for this entire series where we're offering some thoughtful reflections and insights and research on the challenges that we are all facing in today's difficult times. Today, we're going to be looking at some of the wider economic issues that arise from living through a pandemic. And to help us navigate those challenging questions, I've asked our colleague, Andrew Scott, Professor Andrew Scott, who is an economics professor here at London Business School. Welcome, Andrew.
Hello, Julian. My diary just told me I should be getting on a plane to go somewhere, but I think that refers to a parallel universe that didn't happen. So here I am, all set.
Perfect. Well, thank you for joining us. And without further ado, I'm going to give the floor to Andrew, and he's going to tell us a little bit about leading the economic challenges of the crisis. Andrew.
Thank you, Julian. So let me just take over the screen share. And thank you, everyone, for sparing your time to join us today. I just wish we were here to talk about something other than the impact of this horrible virus on the economy. As an economist with slightly unusual specializations in business cycle and longevity, these are particularly bleak professional times for me right now, as clearly neither GDP nor longevity will do very well during this period. And given that, it's going to be hard to avoid the context of being a dismal scientist, but I suspect that none of you were signing in expecting Fun Time Friday. So let me try and tell you what I want to try and do in the time I have. I'm going to spend, as Julian said, about half the session going through my presentation. I'm going to begin by talking about where we are. I then say something about what to expect, although the thing I want to really focus on is just the degree of uncertainty we face right now. I'll then say a little bit about what governments can do and what they are doing. I'll focus on what firms should also be doing during this time. And then I'll end with some longer term conjectures about what this could mean for society and the economy. However, before I begin, I want to learn something from you. One of the problems of being an economist is trying to forecast the future, but the real problem is knowing what's happening today. And there's enough of you online, I think we had about 6,000 people register for the session, that we can do a little bit of a survey. So Sad, I wonder if we could load up the very first poll. What I'm interested in is the extent to which you have been impacted so far by COVID-19. Obviously the poll's going to be a little bit unscientific. For those of you who are busier than usual, you're probably not logging into this webinar, but there are some out there. Obviously the health sector is very, very busy. And our online team is of course very, very busy as well. But I'd be very curious to know what your experiences are. Sada, perhaps you can show us the results that we've got in so far. Okay, so that's interesting. So around 1 in 4 of you are busier than usual. I think as an economist, what I find interesting that is whether that's, as it were, adjusting and closing things down or boosting things. But you can see you really have got a huge spectrum going across this. And we've got modal response busier than usual, but there's an awful lot of weight clustered around that period from 25 to 75%. Clearly we know this is taking a very big hit. The second question I want to ask, and if we can load that one up as well, Sada, this is a harder question. This is about the future, and it's about your own guesstimates or estimates of how long you think the shutdown may last for, the bulk of the shutdown may last for, how long you're preparing for this furlough to be occurring. So interested in your views on that one. Sada, can you show us the results, please? Okay, so we have a nice range of answers. Not many of you are expecting end of April, and our median guess is around about the end of June. So that's very, very helpful. We've got some very significant impacts on the economy, and we're also expecting this to last, at least in terms of the shutdown, the virus itself, and how we respond public health-wise, until the end of Q2. Of course, the question is, what does all that mean for the economy? And when the economy emerges from the shutdown, will the economy roar back quickly? And that's one of the themes we'll be trying to look at. However, let's just start from where we are. And of course, we all know we're in the midst of a 1 in 50 or 1 in 100 year pandemic, which I think none of us have ever previously experienced. And of course, we've entered this unprepared. I used to study seasonal fluctuations, and Christmas is a time when the economy shuts down in a major way and then picks up again quite robustly. But of course, we're rarely surprised by the timing of Christmas, and we know how long it will last for. So the real problem here is the fact we were unprepared for it, despite, of course, frequent references by medical experts that a pandemic would occur at some point. It's also psychologically very difficult. I think that adds to the nature of this economic downturn. When a trip to the shops makes you think about mortality, psychologically these are very, very stressful times. Combine that with just the sheer uncertainty and ignorance of what is occurring, and obviously this is hard, and somehow we have to sort of both think about worst case scenarios whilst trying to hope for the best outcomes, and that certainly creates a psychological stress. I'm forever trying to sort of find the bright side in things, and one bright side for me is I hope we'll hear less talk about disruption and technology, because COVID clearly has shown us the true meaning of what it means to be disrupted. So where are we in terms of the economy? Well, this is almost not a forecast, this is just almost arithmetic. A sharp and a deep recession seems inevitable, and here I'm just trying to do some calculations to show you the impact on GDP. We can talk in a moment about the plausibility of these calculations. But if we assume that just 20% of the economy shuts down completely for 2 months, and obviously the polls you gave earlier suggested it would be more like 3 or 4 months. But if 20% of the economy shuts down completely for 2 months and then completely recovers, so there's a perfect recovery, that's a loss of GDP of just over 3%. And of course, if it's 2 months of a shutdown and 2 months of half a shutdown, then that's about 4.5%. And if you double the length of the shutdown, then you double the loss of GDP. It sort of scales pretty well. And so, the obvious thing to see here is that we are going to see some very bleak GDP growth numbers for 2020. We're going to see very, very large negative declines in GDP, of which we are already seeing them. The next slide is not for the faint-hearted. This is weekly US jobless claims, so people registering as unemployed. And it goes right the way back to the late 1960s, and then right the way up to yesterday's US numbers. And there lies the scale of the challenge that we are facing. Economists, I have heard a couple of times referring to what we're going through as the Great Cessation. We had the Great Recession in 2008-9, we had a Great Depression in 29-32, but this is something the like of which we haven't seen before. And that Great Cessation claim, whether it will become popular, I have no idea, but I think it's useful to make the point that this is not a usual recession. Partly you can see that in the scale here of the unemployment claimants. You go back to previous cycles, even the Great Recession 2007-9, and you can see that slow uptick and that high peak, but it's a peak that's nothing like what we're seeing right now. And obviously, if you notice the past business cycle, there's a momentum, they propagate, they build up over time, where this one is going to build up over time on this basis. It clearly is going to be horrendous, but we're not sure that's the case. This is a very, very unusual downturn. Partly we expect the severity of it in its steepness and its speed to be greater than past recessions. And that may change the future nature of the recovery. It is, as a shock to the economy, really quite unique. Economists think about business cycles being triggered by shocks. And normally we spend a lot of time trying to identify what the shock was and when it occurred. But here you can just literally visually see it. So we've got this Great Cessation. Now, the other thing that's unusual about this recession, if we want to carry on calling it a recession, and as I say, this is a very different type of economic slowdown, is that, excuse me, it's being triggered by a government policy to try and contain a public health problem. So this chart here, the top half is showing you the spread of a disease, and without containment, you get this pink line here. But if we shut down and stop people from working or encourage them not to work, we push back the curve. But of course, in doing so, we make the economy, which is shown here, worse. We make the recession all the worse. So this is an unusual economic slowdown, and it is a direct consequence of government policy. And that's important because, of course, normally government policy in a recession is about trying to get recovery going again. But the point is not to get the economy recovering now, but to make sure that when it emerges from this public health crisis, that it can recover. The other unusual nature of this recession is it's being hit by both supply and demand shocks. The supply shock is either people are ill and can't work, but of course right now the biggest supply shock is people at home not being able to go to work. And so you have a negative impact on supply. But of course the economy is interconnected, so there's also a very large demand shock. As people can't get out, certain sectors like the restaurant and the travel sector, there's no expenditure. And of course, the worry is that we then get an interaction between these two. And as people lose their job, they don't spend, firms go out of business, so supply is continually disrupted. But dealing with a business cycle recession that has features of both supply and demand shocks makes this a more complicated recession than normal. So what can we expect? Well, I'm going to try and go through some thoughts about the future. Those of you who have been in my class before will know that I always warn you never to really believe an economic forecast. Forecasts are best in usual times, and these are clearly not usual times. And sadly for me, one of the problems with economics is the worse the economy, the more people are interested in economics. But often people's interest in economics is greatest when we ourselves know the least. And there is such fundamental uncertainty about the future that it's not going to be reduced by looking at an economic forecast. And dealing with that uncertainty is going to be absolutely crucial for businesses. There will, of course, be lots of forecasts out there. I wish and I hope that economists would be like epidemiologists. And the epidemiologists really aren't offering forecasts, they're offering scenarios. And that, I think, is also how you should be thinking about the economic future. There's another challenge, I think, which is to some extent we're all becoming epidemiologists, but the more you know about something, it doesn't necessarily mean the more confident you are about making statements about the future. So I think we should all be a bit careful about confident statements about what is to come. So how can we make sense of the future? Well, we can look at what history can tell us, and we can also then start thinking about different scenarios. So if we look at history, there's one study recently by Robert Barrow and co-authors that looks at the great influenza pandemic of 1918 to 1920, where an estimated 39 million people died, and some estimates go as high as 50 to 100 million. Now, as I'm sure you're aware, most people believe the mortality rate from this virus will thankfully be much, much lower. But do remember too, there's a world population that's 4.5 times larger now than in 1918. So in terms of millions of lives at risk, we are still talking about a staggering number of people. Now, the challenge of trying to work out the impact of the great influenza pandemic on the economy is, of course, it came at the end of the First World War, and also at a time when GDP data wasn't being collected. So there's lots of assumptions and lots of unraveling to be done, but the Barrow study, looking across 43 countries, says that on average there was a 6% fall in GDP and an 8% fall in consumption. So orders of magnitude similar to what our simple arithmetic was suggesting. Now, the question then is, how relevant is that? If the great influenza pandemic had a higher mortality rate, then we might think of this as an upper bound in terms of the scale of losses. The only, of course, problem is that if the world is more interconnected today, and if the policy shutdown is more complete, and of course the private sector is much bigger now than at the end of a war, you may well find that actually the impact may be even more significant than these numbers. This chart is taken from a study by Richard Hughes from the Resolution Foundation, and it looks at 7 different country experiences of pandemics. 3 during the Spanish flu, the Hong Kong flu virus in the 50s, and then Ebola in 3 African countries recently. And if you look at this chart, what it's trying to show you is that this line here, this single line, is the average across all the countries prior to the pandemic. Then you see the pandemic hit, you see a fall in GDP, and then you see a recovery. And the bands around it show the variance across different countries. So of course, what you see if you look at this average response is you see that on average, you get falls in GDP of around 10, 15%. You then get a recovery, but on average, it takes 3 years for GDP to get back to what it was. But of course, the average is not terribly reliable. In the case of Hong Kong, you see a sharp, with SARS, you see a sharp recovery. In the case of the African economies, you see a very, very sharp downturn and a much, much slower recovery. But what we're seeing here is on average, a return of around about 3 years for GDP to restore itself to its previous level. Now, I want to keep sort of making this point that forecasting is challenging. The metaphor I often like to use is that economic forecasts are like a light in a refrigerator, where the light only comes on when you shut the door. In other words, it's most unreliable when it's most needed. And there are, of course, 4 very big unknowns that we face right now. We don't know how long the spread of this disease will last for, or when, if ever, a vaccine will arise. We don't know how long the public health shutdowns will persist. How long will governments decide to carry on doing this? How long will the public put up with it? We have no idea of the knock-on effects, what is called the economic scar tissue, that will emerge from an economic shutdown. And of course, we have no idea how good policymakers will be at keeping the lights on. And of course, different answers to all 4 of those questions give you totally different economic forecasts. So if you're confident that you know the answers to each of those 4 questions, then you may be confidently predicting the future. But at least for me, I really don't know the answer to any of those 4. So economists are tending to talk about scenarios rather than forecasts. And whenever economists talk about business cycles, they wheel out this alphabet. So we're talking about the recovery being V-shaped, top left, a U-shaped, top right, W bottom left, or L-shaped, bottom right. Let's just quickly go through each of these, and then we'll try and sort of produce some scenarios from them. The bottom right, the L-shaped one, sort of says we're going to have a permanent shutdown, a permanent loss of output. Firms will go bankrupt and we just kind of won't recover. That is pretty unusual, and clearly at some point the economy will recover. The W shape is dependent on the path of the virus. If we keep having lockdowns and removing lockdowns, or if the virus comes in waves, then clearly the economy will go up and go down in response to those waves, and we get something like a W shape. Assuming that we don't see waves of the virus, and as I say, I'm not an epidemiologist, so I don't know if that's plausible or not, really we're looking at one of the top 2, the V and the U. Now, these sort of ways of looking at the economy are kind of nice and intuitive. They are, however, a bit like the map of the London Underground, in the sense that their simplicity and insight comes at the cost of a lot of detail. You simply haven't got time frames and distances attached to this. And obviously, if you look at annual data, you may see something that is V-shaped, but if you're looking at monthly data, it may be something that's U. And indeed, if you're looking at weekly data, you may just be experiencing an L for quite a long time. But really the key thing here is that, are we going to see this bounce back once the economy recovers? And it's important, the way I've drawn here, to sort of look at 2 questions when we look at the V-shaped recovery. One is the speed. And I think it's pretty obvious that the speed of recovery will be asymmetric. The speed of the shutdown was dramatic, and it will be harder to pick that up as quickly as possible. The second question is, what do we return to? Because the V itself may be lopsided. And obviously, the less we see a destruction of physical capital and firms going bust, and the more we can hope that the V will have the same height at the end that it does at the beginning. But that's what policy is trying to maximize. The V shape does require that the temporary shutdown we're seeing now solves the problem. The virus is then manageable, and we get an economic recovery. The U-shaped scenario has two reasons for this sharp slowdown and then a prolonged recession. The one is, of course, the length of the shutdown, which, as we said, is deliberately engineered to reduce the scale of economic activity. But of course, the danger is that one has knock-on effects, that firms going bankrupt, people losing their jobs, you then create a downward spiral of low demand. And I'll come to this theme later, but we do know that we will see a permanent loss of wealth as a consequence of this period. We will be using resources to fight the infection, to dedicate public health, but also to maintain the standard of living during this time period. So there will be a permanent loss of wealth, which will lead to lower demand. And that can lead to these amplification effects here. So the degree to which the economy recovers once the lockdown finishes will depend upon the resilience of the economy to bounce back. And that will critically depend upon the role of governments, which we'll come to in a moment. So as I say, a V or a U, the V shape is if we just get one temporary shutdown and government policy can tide us over for 2 or 3 months. If the shutdown goes into the second half of the year, then the economic mechanisms are going to start to prolong this recession, and recovery is in 2021. What to look out for? Lots of things I want to try and focus on here. The first is that, if you think about these recoveries, you're likely to see some terrible GDP numbers and then some very positive GDP numbers whenever recovery happens. Whether it's the V or the U-shaped recovery, at some point you're going to see some really spectacular GDP numbers in a positive direction. But the thing to look out for is not the growth rate, but the level. A 30% decline followed by a 20% increase still leaves you a long, long way back from where you were previously. So really important to focus on the level of output, the level of GDP, and not just the growth rate. The second thing is that GDP data occurs with a lag. So you're going to be hearing some awful GDP numbers, but do remember they won't be telling you about the state of the economy the day you read them. They will be telling you about what had happened. So we'll get some GDP Q1 numbers in the midst of Q2, and they'll be bad, but they won't be as bad as the Q2 numbers, which will be released in Q3. So when you do see these terrible, terrible numbers for GDP, still yourself, because they're not necessarily informative about what will be happening at the time that you read them, for all sorts of reasons. One is GDP will be particularly unreliable in these circumstances and subject to all sorts of survey and measurement errors, but it is just inherently a lag involved because of the collection of GDP. The other thing is, as a macroeconomist, I'm focusing on aggregate output, but of course, it may not be the same firms who come roaring back. Some of the restaurants and bars who go under during this time may come back eventually, but it may be under different ownership. So, GDP will show the aggregate outcome and who's producing, what's being produced, but not who's producing. The other thing I think is important to sort of bear in mind as a business right now is that GDP focuses upon output, but there'll be some pretty sharp changes in relative prices as well. As demand and supply fall in different combinations in different sectors, you may see your output falling, but you may see the price of your output shooting up. Or of course, you may, as is the case of webinars, see a massive increase in production, but the price tumble to zero. So don't just look at the output numbers, think also about some of the shifts that will be happening to your relative prices. Now, this is obviously a big problem. It's a complicated problem and one that requires government intervention to try and do something about it. And just as the epidemiologists are trying to flatten the curve, so too are economists. And as I said earlier, what we've got to try and do is not stimulate the economy now, but sort of shield it. Freezing is the metaphor that everyone's using right now. And this is a different type of recession. It hasn't originated in the financial system, even though it's going to cause lots of financial problems. So central role here will be done through governments and fiscal policy, that is through taxes and government expenditure and government debt, rather than just interest rates and liquidity. And the general consensus, given the size of this shock, remember that size I showed you for US unemployment, is that governments need a big bazooka. It's better to do too much rather than too little. Notice the military metaphor, because we are, as is often said, at war against this virus. And in wars, you see a massive surge in government debt. The package the US government passed last week is going to cost at least $2 trillion. That's 10% of GDP. So we're obviously going to see a big increase in government debt. I'll come back to later whether that's how long that can carry on for, but wars last a lot longer than the war against this virus will. So although we are on a war footing, although we will see big increases in government debt, it won't be of the size that we saw during true military wars. And of course, the economy will be different as well. During a war, the economy is skewed massively towards the government producing the things it needs to fight a war. And thankfully, we are seeing firms producing ventilators and sanitizers, but the economy is not being skewed so much towards producing what the government needs as during a war. And that's important because when the recovery happens, the supply side of the private sector won't be as badly impacted as happens during a war. I do, however, think it'll be interesting to see whether, although governments may not be taking over the means of production and taking over factories in the way they did during war, it's clear that if we are to improve the trade-off between public health and the economy, then governments may have to get a lot more involved in the collection and monitoring of information. That may be our 21st century of governments taking over the means of production. Now, just to sort of make this point about what happens during wars, this is the US fiscal surplus, which is more often a deficit. And you can see that stunning number during the Second World War. You can see the very large number during the 2007-8 financial crisis. And if we see what the commitments that governments are making right now, we can certainly expect a number on a par with the financial crisis, and I think probably larger than the financial crisis. So probably likely to see in 2020 double-digit fiscal deficits in countries affected by this crisis. And that to me seems entirely appropriate. This is some chart taken from some work with Martin Ellison at Oxford University, and it's showing you long-run fluctuations in government debt. And you'll notice that the level of government debt in the UK is not terribly high. During war times, it's gone much higher, and the debt is paid off over a very long time period. If this really is a 1 in 50-year pandemic, then the appropriate way of financing it is over 50 years for the government debt to increase and then slowly come back down in the years ahead. There are, of course, risks attached to all of this. The first is we kind of don't know what we're doing. As I said, this is unprecedented, this is unusual, and governments and economists are trying to understand what is the impact of this shock, where will it manifest itself, and how do we correct it? And I do think one of the biggest challenges governments have got is finding out who's most affected by the crisis and finding out ways of getting the money to them. And inevitably, those who are most hit are often the ones who it's hardest to help. There's also issues about how long the government stimulus can continue. We're probably talking about 10–15% of GDP over the next year and a half for many countries. And countries clearly differ in their ability to increase their government debt by that magnitude. For most countries, I think that's feasible, but for emerging markets, it's going to be very challenging. We're already seeing capital flight as money flows back to rich countries, and that's going to leave emerging markets very vulnerable. And obviously, the poorer the country, the less capable it is of dealing with a public health crisis in the first place. The UK and US, which can issue their own currency and issue their own debt in that way, clearly have an advantage. But this is obviously going to be a very big hit for the Euro system. The Euro system was hit hard by the great global financial crisis of 2007-8, and that led to a big institutional innovation to try and make the system more robust. But yet again, here we have another shock that is kind of ruthless in the way it's focusing on the weaknesses of the Euro system. It hit Spain and Italy hardest, which were the countries probably most vulnerable in terms of public finances. And the challenge of the Euro system is that it is a common currency with a common monetary policy, but not a common fiscal policy. And so although there have been efforts made to try and enable governments to spend more to deal with the crisis this is a shock that is targeted at some of the significant weaknesses within the euro system. So it's going to be a tough one to develop the institutional response to achieve that. People are worried about interest rates and inflation. If you're looking at government debt, the two key variables are the interest rate they pay and the growth of the economy. And right now, those have been quite favourable to government finance. I think they get less favourable, but given the level of interest rates today, I don't think we need to worry about the increasing government debt that is happening. I also don't think we need to worry about inflation. We may see increases in inflation further down the road, but there is no inevitable consequence of increases of government debt of 15, 20% of GDP that will necessarily lead to inflation. And the key thing for inflation when recovery happens will be the balance between supply and demand. If demand roars back and supply is being impacted, we'll see inflation. But right now, it seems hard to imagine a world where demand will roar back that quickly and supply will be that impaired. Just want to talk one more thing about the balance between the economy and public health. I mean, there's obviously a growing, and there will be a growing debate about the trade-off between letting the economy go into free fall and saving lives. And economics is all about trade-offs. Now, there's a literature in economics which is based around the concept of a value of a statistical life. And it's not intended to answer the question of how much you pay to save a single life. It's more looking at probabilities. But if the US government has a number that they use in calculations around the environment and transport that says the value of a statistical life is around $10 million. Now, if you use that number to think about how containment can save lives, you quickly come up with a conclusion that very large shutdowns in the economy are worth it. The Imperial study suggested that without containment, the US would see 2.2 million deaths. If you can save 2 million deaths, that's worth huge amounts, not just at a sort of intuitive humanistic level, but even if you put it through the economic calculus of VSL. In fact, one Chicago study has estimated that containment will save lives to the worth of $8 trillion. That's around 40% of GDP. Of course, those gains are heavily skewed towards the older generation. And as someone interested in longevity and intergenerational issues, I'll return to that at a later point in some writing I'm doing. But clearly, there isn't at the moment really a trade-off between health and the economy. This is a cost that is worth bearing. And even were we to remove the shutdown, we would still, of course, see an impact on GDP because there will be so much absenteeism. Now, of course, just because these calculations suggest it's worth seeing a fall in GDP doesn't mean we shouldn't try and improve the trade-off. And it seems inevitable to me that governments will have to work much greater and improve their policies around testing and monitoring as the only way to improve this trade-off between economics and health. I'm conscious of time, so I want to just try and touch a little bit upon what firms should be doing during these times. And, you know, it does feel a little bit like one of those nature films where time speeds up, where things are happening very quickly. And obviously, trust and decency are paramount, both as an individual and a firm and a government. You're going to be judged for years to come by your actions today, which is a sobering reflection, I think. Now, one of the things I want to talk about is this need for robust versus optimal policy. Now, you're probably aware of the concept of black swans popularized by Taleb. And clearly at one level, this seems to be a black swan, this shutdown that no one foresaw happening. Well, we probably need to look out for more black swans, because whilst one of them is staring us very much in the face right now, these exceptional circumstances are going to be leading to other challenges, other extreme events. And when we don't know what the future will bring, when we can't forecast in a reliable way, we have to switch from the idea of an optimal strategy to a robust strategy. So what I mean by a robust strategy is kind of settling on what you think is a worst case scenario and then setting your policy about how to survive it. So earlier on, many of you were saying you think 2 or 3 months is how long the shutdown will last for. If that's your average forecast, what is your robust forecast? How do you prepare yourself against the worst case outcomes? Now, this requires enormous judgment because you can't worry about everything in these circumstances. But really, where there's so much uncertainty around, this is not a time to think about doing the optimal thing, but to doing the most robust thing. And of course, what is challenging in these circumstances is knowing what is an overreaction. The other advice I'd offer to firms is to try and think about sticking to the mission and not the plan. We all like to try and keep control in these circumstances. We all have seen this enormous disruption. I think many people are saying, well, let's just try and roll out the plan in a different form. But actually, the plan just may not make sense in these circumstances. What really is the mission of your firm or your organization? And given the disruption that's occurred, what is the new plan that helps you stay consistent with that? There's a lot of tension to try and just carry on doing what you've always done, but in a slightly different form. I'm not sure that's sensible. And particularly what I find at the moment is lots of people are just being very busy. But farmers don't sow seeds in winter. This may not be a time just to be busy because that's not quite the same thing as being productive. And that then leads me on to this theory of recessions as a pit stop. In Formula One racing, the winning team always does something very strange. They stop. They pull out and stop racing so they can retune the engine, change the tires, and go about and be faster than after. And when we've got such a deep recession, of course you'll be thinking about cutting resources, but reallocating resources is going to be really important because the opportunity cost of some projects is much less now for firms. When your order books are full, when there's easy revenue to be got, taking resources away from meeting those revenue needs to look at long-term planning is not a very good thing to do. It's a high opportunity cost. But when there isn't the demand there, when there isn't the revenue, the opportunity cost of long-term planning is much, much less. So of course, now is the time to focus on those long-term projects you've always wanted to look at and to think about the trends that will emerge because of this crisis and make sure that when recovery happens, because it will in some form or other, that you are well set to make the most of the time until the next downturn. So that's about not being reactive, but dealing with non-reactive things. The other challenge for firms, I think, right now is how to deal with the bounce back. We don't know when it's going to happen, but of course, all of you are used to seasonal fluctuations, but don't expect the normal seasonal fluctuations to reappear. I noted lots of firms saying, well, in September, things will be back to normal. Well, actually, why have an August shutdown if we can still produce the economy? We will see a major change in seasonal patterns. And I think one of the key issues here is that when things stop being abnormal, that doesn't mean things go back to normal. I think it's easy at this point in time to think that all of future history will be different because of this crisis. And I'll just try and go through a few ways in which I think we will see some differences. I do wonder if our faith in progress might be tested. For all our sophistication as a society, we've shown ourselves to be as vulnerable to a virus as past generations. If we can come out of this as a result of our technologies, that may enhance our faith in science and progress, but otherwise we may find ourselves challenged. It's clear that there are some problems that only the government can solve, and I think that will have knock-on implications for how we tackle with AI and robotics and environmental sustainability and an aging society. And then, of course, the big question will be around politics. It's too early to know what the reaction will be. The financial crisis and austerity, the political reaction took a surprisingly long time to come through. This time round, it'll be quicker. This is a crisis that's affecting everyone much more swiftly. And of course, this will partly depend upon the success governments have in implementing their policies. But surely one of, to me, the most encouraging things that I'm seeing right now is that civil society is beginning to rediscover its power and its importance. And I think that's going to be a really big political development from this crisis. We know that in dealing with the responses like AI and technology, we need governments and civil society to come together, but civil society's had a weaker voice of late. But one of the things that does seem to be boosted by this terrible experience is a sense of the power of the community. And I can see some interesting narratives changing. In economics, when I give my classes about globalization and technology, we talk about skilled and unskilled workers. Now the dialogue is about essential and non-essential workers. And the overlap between skilled and unskilled and essential and non-essential is very different. So clearly, I think we're going to see a shift in the social narrative. I'll try and wrap things up a little bit now. Obviously, health and economics are fundamental to our well-being, and right now both are making for grim reading. Bad times do, of course, pass, and every day we'll be giving opportunities to be better neighbours, better team members, better family members, and better customers and employees. The situation, we must remember, isn't as bad as the great influenza pandemic. We are at war against a virus, but it's not as bad as an actual war. And do remember that the great influenza pandemic didn't stop a century-long increase in life expectancy and enormous improvements in GDP. Humans and our society are very resilient, as I hope you are as well. Thank you. I have written up a report on the basis of the presentation, so if you do want to download that, you can just go to my website and a fuller version of this is available.
Thank you, Andrew. Terrific stuff. So hundreds of questions, and we're only going to get to about 8 of them is my prediction. We've got something like 15 minutes before we close. Question number 1. What is the effect on the average citizen of the post-recovery expenditure? You already said you don't expect inflation to go up dramatically. You don't expect interest rates to grow up dramatically. How will we as individual consumers experience the 10, 20-year consequence? Will our kids be paying for this? How does that all work in practical terms?
So there's clearly going to be a permanent impact on wealth. And this is not to do about whether the stock market recovers to reach the heights it was before the crisis. But those of you who have got assets and wealth will have to run them down. Firms are clearly being impacted and government debt is higher. So there will be a permanent loss of wealth, even if GDP recovers to what it was. So how's this going to affect us as a society economically? I don't think it takes 10, 20 years to recover from this, which we saw the GDP data takes 3 to 4 or 5 years. We saw the financial crisis, it was 3 or 4 years. So this should be something that is not a decadal long influence in terms of GDP. Of course, the impact will be hugely different across different people. Some will have their assets completely wiped out, but we will see a fall in wealth. So everyone, even those who maintain their employment later, will see their living standards down because their wealth is less. They may see their income go down because wages may have to go down. And of course, those who sadly do lose their job, there will be a time before they get a new one. And that clearly has a bigger impact on wealth. So this is not the end of capitalism. This is not the end of GDP, but it is something that will have a long run impact on wealth, a shorter run impact on GDP.
Got it. A couple of technical questions. One is, how did government actually finance this? Where's the money coming from? I mean, obviously governments print money, governments borrow money. Just help us with a few of the practicalities of what that looks like.
So government debt, I mean, you've got a bunch of options. You've got pay for it from tax, government expenditure pay from taxes today. There's no point raising taxes today because obviously that will hit a weak economy hard, and we're giving tax holidays. So there'll be a postponement for later taxes. And obviously governments are giving tax holidays, and so part of the increase in government debt is not getting the tax they were expecting to get, but which they get later. Secondly, you can of course sell government bonds, and this is where it gets a little bit tricky because you can sell government bonds to the private sector, and of course the question is, will the private sector be buying those government bonds? And if the private sector is less keen on buying those bonds because I think the government is unsafe, because they haven't got so much money, then the cost of borrowing for the government rises. And I think you've got to have to look at the impact on pension funds and insurance companies to say, well, we might find government debt actually having a higher interest rate. But remember, they're incredibly low right now.
Right.
Now, of course, corporates will face a very high cost of borrowing, as we saw recently with the cruise company. But the other option is governments could print money. Now, printing money is done in slightly different ways. It's effectively the central bank buying the new government bonds that governments issue. As yet, that's not what's happening. And it's not even clear that if it does happen, that will trigger inflation. So the majority way governments have of increasing their debt is by selling bonds. We are seeing central banks buying bonds up in the secondary market, not the primary market. That's what they did after the financial crisis. That didn't trigger inflation. So if that's what they continue to do, we won't see a big increase in inflation from a big increase in government debt.
Got it. And presumably, I mean, people worry about hyperinflation. They've read about it. And I guess some countries like Brazil have experienced it in our lifetimes. I mean, is it the case that macroeconomists like yourself have, shall we say, figured out how to solve that problem? I mean, is it safe that we won't get into that sort of depths of problem again?
No, I mean, certainly, governments who have to continually increase expenditure without a means of taxation or borrowing, and so who just resort to printing money permanently, get hyperinflation. But that's not the situation that we're talking about right now. Now, of course, some governments will be very vulnerable. Their economy will be hit very hard. Their ability to borrow will be limited, and they will end up printing money repeatedly. But I can't see that happening in a major economy. Right. So, the increase in government debt we're talking about is significant. It's probably the order of, let's say, 15, 20, possibly 30% of GDP. That is coming at a point where government debt is already high. But for the rich, advanced economies, I wouldn't say we're anywhere near the limit of fiscal capacity. Within the euro area, there may be some challenges that come about with the current system. But certainly the US and UK, there's nothing inevitable about much higher inflation that comes from this.
Got it. So lots of questions about the U versus the V versus the L-shaped recoveries. And, essentially one question was, can you give us an example where an L-shaped recovery, almost like a not recovery, occurred? And do you see that different countries are going to be on different tracks as the recovery happens, and what would impact those trajectories? Yeah,
so I think there are L-shaped ones, but it's the L-shaped one is all about the time horizon you look at. And eventually you get something of economic growth coming back again. The L-shaped one, if you're a firm and you go out of business, then it looks like an L-shape to you, and so you don't care what happens to GDP. But GDP itself will have some form of recovery. So then to me, it's either the V or the U. It's all, of course, about the angle at which the recovery occurs. I think what's going to be really interesting about this is the speed at which different countries respond, because clearly there's been very little global coordination. This is a global pandemic, but the global coordination has been completely missing.
Yeah.
And we are going to see that the size of the shock, the efficiency of the government response to the public health crisis, the ability of governments to respond to the economic shock is going to lead to really big differences across the world as to how economies recover. And again, that desperately needs some global coordination, but I'm not very hopeful that we will see that occur.
Got it. Excellent. So a question about China. Obviously, China is ahead of us in terms of, first of all, going into a crisis. Chinese consumption helping us to recover. What are your thoughts about what, as it were, China is going to do, either positive or negative, in terms of the impact on the rest of the world economy?
Yeah, no, China's obviously the second biggest economy in the world. If it starts to pick up, that would be good for the rest of the economy. The Chinese consumer, the Chinese government want the Chinese consumer to spend more. I mean, it's simply not a very big number, I think, for the rest of the world. Most of the world's economy is driven by domestic consumption. So certainly, you know, we want the US to do well, we want the China to do well, but China will focus more on its own domestic demand rather than single-handedly try to reflate the world. So yeah, Chinese recovery, good for China, good for the world economy, but it's not the cavalry coming over the hill given the size of this recession.
Understood. This is a niche question for some of the audience, not all. How do you think professional services firms will be impacted through this period? I wouldn't be surprised if, you know, as many as 30-40% of the people on this webinar are working in professional services.
Well, I mean, clearly people are going to need a lot of advice. The professional service firm is, like everyone else, going to be cyclical. I think if you look at the pit stop theory of recession, which is obviously the positive side of all of this, then some of that long-term thinking will require skills and expertise that the professional service firm has in strengths. More grimly, of course, insolvency experts will obviously be very busy, and people advising on corporate refinancing will also be busy, because that's clearly going to be important. So there's a downturn, and that's the industries that normally do well in professional services.
I'm going to finish with two big questions. Is capitalism responsible for exacerbating the problems? And I think what the question is sort of saying is let's not talk about how we got into this very difficult situation. As we start to recover, there's going to be more, you know, authoritarian versus more democratic ways of approaching the recovery. Your thoughts on which of these is likely to prove more robust or more effective?
No, I mean, I think it's clearly going to change our concept of what a government should do. And I mentioned earlier about taking over the means of information, and clearly to improve the trade-off between health and the economy, government's going to need access to a lot of information that currently they don't get. And that's going to be a major political issue in all of this. I put it slightly different. I never quite know what people mean by capitalism. That's not a dumb point. I mean, it's sort of, clearly capitalism is one around the world, unless you're a fan of the North Korean model. But the question is, what type of capitalism? And, you know, I think what's really interesting to me is that, you know, given the severity of the economic decline, it's still the case that most people are saying this is the right thing to do. And I know the voices against that are going to get louder and louder, and people say, well, we can't carry on doing it for longer. But I think what is really interesting is how the whole economy is now willingly subjugated to approve a public health aim. And the notion that capitalism, therefore, is all about profits, I don't know, that seems to be sorely tested here. And I think what we've had in a very painful way is a realization of what really matters to us. And that may well be the big trend going forward. But that seems to be something that it's about a different type of capitalism rather than the end of capitalism.
Right, because obviously capitalism, I mean, I can speak for the UK because I understand this best, but, you know, there's no shortage of what we might call traditionally socialist approaches to, you know, paying people and coordinating responses and nationalizing entire sectors. And I guess the point is that capitalism is inherently flexible and can adapt to circumstances.
Yeah, I mean, clearly what it's shown us is that there are some problems only the government can resolve.
Yeah.
And, you know, the government is now the insurer of last resort, which it always has been. And I think we can sort of see clearly how, without the government fulfilling that role, then the economy has a major challenge. But as an economist, you know, we always know that the challenge is not, is there a role for government, but what is that role and how does it do it well?
A final question before we close. Couple around climate change. I mean, before, you know, 4 months ago, there was a lot of talk about how to, you know, developed economies in particular, but I guess the whole world, figure out a way of actually building proper responses to climate change into our economic models. And then suddenly we've got a whole set of new challenges. Do you see that these challenges can be, shall we say, dealt with in a similar way that we should be thinking about climate change? Do we even see some positives of or silver linings to the current crisis in terms of the impact on the climate? Any thoughts on those two issues?
Yeah, I mean, I think, you know, if you argue what are the big events that could bring about major costs to us as a society, clearly they are around how we adapt to technology, how we adapt to a more sustainable environment, and now, of course, how we deal with pandemics. and future planning will be important. I do hope that what comes out of all of this is, for both myself and for everyone, a better planning for extreme events. The trouble is, of course, is that if anyone's involved in a motor accident, you then start to drive carefully for a little while afterwards, and then you tend to revert back to behaviour as before. I hope that's not the case this time around, because thinking about it economically, the sort of preparing for the future dislocation of climate change is exactly the same as preparing for the future dislocations of pandemics. And I said earlier that if you have a 1 in 50 year pandemic, you can pay it off over the next 50 years. An even better way to deal with it is to prepare yourself so that when it happens, the impact is much less, because you've got the ventilators in place. And that principle is exactly the same for climate change.
Got it. We are going to close there. Before we go, could we just have a little preview of the next one of our events, which is on Tuesday next week. I will be hosting, as always, and my subject will be Professor Yanis Ioannou, who's a colleague in the strategy and entrepreneurship part of the London Business School. He's going to be talking about navigating crisis lessons from the Great Recession. What can we learn, particularly about what companies did in the Great Recession and post the Great Recession, and how we can learn from those in today's challenging times. So if you go to the URL at the bottom there, london.edu/pandemic webinars, you can sign up for Yanis's presentation. And of course, you can also sign up for all future presentations, and indeed get copies of all of the materials from the ones we've already done. These seminars, these webinars will be going out all the way through April into May. We've been getting steadily increasing numbers of participants. I think we've had something like 3,000 people today. And so please do tell all your friends about these events. They're very enjoyable for us and hopefully informative to you. So with that, we will close. Thank you, Andrew, once again for doing such a terrific job and answering all our challenging questions about the economics of pandemics. And we will see you all on Tuesday. Thank you very much and goodbye.